The tech sector has been one of the best performing areas of the market in 2021. I think it's fair to say that. And of course, it's underpinned by what's been happening with Apple as it approaches $3 trillion in market capitalization. Is the tech sector still a good bet going into 2022? We're talking now to Pelham Smithers from Pelham Smithers Associates. Pelham, it's good to catch up with you again. Now, I know that you're a specialist in the Japanese tech sector, but I wanted to take a look, first of all, at the global picture and ask you that question about how we go into 2022. Do you feel you're in a good buoyant sector as we approach the new year?
I think that the big problem you've now got is it's quite difficult to discuss the stock market as anything other than a technology stock market. So unless you're going to be bearish about the stock market in general, yes, we should have another technology year next year. The stocks may be different, but I suspect that we will still be talking technologies as the driver in most instances.
I'd like to pick up on that point about some of the individual stocks to talk about a little bit later on, if I possibly can. But another general question seems to me, as someone that covers the markets generally, not tech specifically, is that the tech sector seems to be very, very sensitive to the movement in interest rates. As we've seen US yields rise, of course, the tech sector has been hit. Is this something else that we've got to consider? Because we're looking at the moment at higher interest rates into 2022. Is this going to dent the appeal of the sector?
It's a complicated situation because when on individual days when the bond market weakens, we see tech stocks perform badly. But actually, if you look at the trend, we're talking, bond yields have generally risen and we are close to record highs on SOX and NASDAQ and stuff like that. So what's sort of happening is that when the bond market strengthens again, when interest rates come back, then technology stocks seem to more than make up for the problems they had when the market goes the other way. So unless you're talking about a scenario in which bonds dramatically weaken next year and yields rise accordingly, then I don't think that story necessarily plays out the way people are saying.
One of the other features of 2021 has been the Chinese authorities' attitude to the tech sector, particularly obviously Chinese tech shares. And as we know, some of the best performing IPOs have come through from Chinese companies. I'm thinking back in terms of years back to Alibaba, one of the biggest of its type, and we've seen Didi come to the market. Now China is beginning to clamp down. Now this is closer to your area of operation. What is your thought on what China is doing? Is it a long game that they're trying to play here and they're trying to reinforce certain aspects of the market they want to control? Or is it something that they really don't understand in terms of the way that the West is approaching the tech sector?
I think they have a very good grip on understanding the situation. I think that it's not Beijing's wish to have its premier blue chip companies listed exclusively overseas. And at the same time, they want to build Hong Kong as a market for foreigners to be able to buy Chinese shares. So you've got those two forces acting together to make stocks like Didi and probably Alibaba, become Hong Kong listed stocks primarily or exclusively. But secondly, of course, you've got pressure from Washington as well. Washington's asking for greater disclosure from Chinese companies, which even if the companies were willing to give, Beijing may not be willing to let them give that information. So consequently, it's quite likely that a lot of these stocks will be delisted, not because of Beijing's pressure, but because of Washington's regulations. So I suspect that there may be an element of Beijing getting ahead of the story. So it looks like that they're in control and they are driving the behavior of Chinese business as opposed to Washington. But I think that the two, although they're not acting together, but they're acting simultaneously, will impact in the way I've just suggested.
What about the shortage in semiconductors that we've seen? Is another big feature of 2021, of course, and a number of issues have been felt, certainly bumps in the road in terms of some of the production of some areas of the market where we're unable to see ahead very far because of the problems with the chip shortage. Is that something we're going to see go into 2022 as well, or is that now beginning to be overcome?
It rather depends on what your definition of beginning to overcome is. There are signs that the inventory levels, which have hit sort of 20, 30 weeks, sometimes almost a year in certain specialist areas, are beginning to drift down. We have quite a high level of capex going on right now. It's a lot of machinery being installed globally, and that is helping. But the big problem you got with the semiconductor market right now is data. We are using data so much. We are growing the need for data, and we are using semiconductors to create that data, analyze that data, and send that data. So not surprisingly, if we've got a data bull market, we're not going to get out of a semiconductor shortage anytime very quickly. Probably what will happen is something that we've never really seen before: rising prices of semiconductors from a substantial and sustainable level. That historically, we double production of semiconductors and we lower prices by 30, 40%. That's how it's always worked in the past. Now we're increasing production of semiconductors by 30, 40%. And are we cutting prices? No. Might they start rising? I think they will.
Yeah, and of course, all part of this is part of the supply chain issue, which a number of companies are seeing across the board.
And it's going to be those companies that can afford to pay up for semiconductors are going to be in a very strong position. Those companies who have been used to getting semiconductors at rock bottom prices and don't have the leeway to pay extra are going to have trouble.
So that then means, presumably, if they engage with that business, they're going to have to pass the prices on to the consumer. Is the consumer able to pay more for the technology, do you think? And there's a certain appeal. I started off the interview by talking about Apple. It seems to me that people are prepared to pay almost anything to get the latest iPhone. And I guess that all comes in part of this idea about the fact that Apple's able to feed through prices through the whole supply chain. But there are presumably going to be some problems for some companies being unable to pass these prices on.
That's, I think that is absolutely correct. I think that if you are in for instance, the car manufacturing industry, you have a very sharp rising costs, not just electronics, but steel and chemicals are all there. And you have a customer base which is not used to prices going up. And customers around the world are beginning to feel the pinch after it was almost 2 years of COVID. Some car makers are going to be in a very strong position. Others, I think, are going to find the situation difficult.
Yeah, of course, car makers have got their own issues as well. Of course, fighting against the lobby that no longer wants to see combustion engines on the road. So they've got a separate issue going on there as well. But that takes us into another area of ESG. Which I know that a lot of companies are now wanting to conform to ESG. Is this going to add much, do you think, to the end price of products across the board, or is ESG an easy target for many companies to comply with?
It is both. Japanese companies love ESG because it's something that it's a box ticking exercise, and they've got lots of people in Japanese companies who can get out a piece of paper and pen and tick all the boxes. And whenever I hear that Japanese companies are conforming with ESG, it's always say, what is the exercise trying to do? Are you trying to provide them with a system which shows that the existing system works, or are you trying to provide them with a system to improve the existing system? And if ESG is the first, I think a lot of companies are going to find, like Japan, that they can fill out the boxes in the same way. But if you want to use ESG to improve corporate behavior, product efficiency, shareholder returns, then I think that the market is the way that that's done, as we've seen.
Looking at the market, and indeed picking up this point about shareholder returns, I noticed recently that Toshiba has come under activist investor pressure to look at breaking up, or rather providing more shareholder return. Do you think this is going to be a theme going into 2022? Not specifically on one particular company, but broadly speaking as an idea. Activist investors do seem to be getting hold more of board seats and do seem to be steering companies into not just ESG and looking at better ways of dealing and operating, but finding ways of providing shareholder value. Do you think there's much shareholder value to be unlocked in these big conglomerates? I'm talking not just Japanese companies, as in the case of Toshiba, but across the world. I mean, Samsung is a really good example of a company that has so many angles to it. Surely there must be value to be unlocked in some of these big conglomerates around the world that might find that shareholders are better rewarded for smaller companies spinning off bits of the business they might not necessarily in the longer term benefit from. Do you think that's a theme to watch out for or not?
I think so starting with the Japanese situation, you've got companies like Hitachi who are proactively completely restructuring. Hitachi has changed its business over the past 10 years in the same way that General Electric, GE, changed its business in the 1980s. The company that it's began the decade with is completely different to the company that's ended the decade, with considerable benefits to shareholders. But on the other hand, you've got companies, as you say, like Toshiba, who, having made, errors, or in Toshiba's case, a couple of catastrophic errors, then laid themselves open to shareholder activism, and at a time when they have very little political support. Now, what I find very interesting in Japan is that we've just had a quasi hostile takeover of a Japanese bank. A online brokerage firm called SBI Holdings made an aggressive bid for Shinsei Bank. Under normal old-fashioned Japanese practices, either the government or friends of the bank would have rallied round to ensure that the takeover would not have taken place. But in fact, as it happens, the takeover has gone through, the government's approved it, and we have seen a major change in thinking on that front. Now, that is quite a story, and something that I think will not unleash a tsunami of such events, because these things take time to occur. But I wouldn't be surprised over the next half a decade, we will see a significant change, first in Japan, and then, as you mentioned, in Asia, where there are similar cultural sort of opposition to aggressive M&A, to shareholder activism. I think that this will become a regional quasi-norm.
As I say, I mentioned Apple at the top. I do want to get into some more detail, if I can, about the sector into 2022. I mean, when we talk about tech stocks, we're embracing a lot of subsectors here. Which of the subsectors in your mind are worth looking at in terms of some of the better performances we expected in 2022?
Well, we've mentioned one, which is semiconductors, and I suspect that if we have rising price in semiconductors, then not only should semiconductor stocks of the type that we have seen do well continue to do well, but we'll see sort of offshoots. We'll see more supply gains in supply chain companies as they're able to raise prices. But it's the other side of the story which actually really begins to interest me now. Is Apple a hardware company, or is it a software company? Increasingly, it's making more and more of its money from software, from services, and that side is I think where real opportunities now lie for a handful of stocks. I always bring up Sony in this example because Sony is unique. There is no other company in the world who is a frontline producer of video games, TVs, films, music, and live events. It completely dominates entertainment going into what we're talking about, this metaverse era of virtual reality entertainment. Sony is right at the nexus of this development, and yet its market cap is only 1/20th, 5% of that of Apple. Now, maybe Sony won't monetize its position, and in the distant past, in the early 2000s, it squandered a brilliant opportunity in hardware and gave over to Samsung. So it's not a given. But if you wanted to look at a situation which says that is an incredibly strong position, then Sony is one that we would identify for 2022.
Anything else into 2022 we should be looking at in terms of tech? Because obviously there are, as I said, many areas we haven't spoken about. I mean, tech, the entertainment area is clearly, entertainment content is clearly something which is obviously going to be of interest next year. Do you see, broadly speaking, tech doing well in 2022, or do you look out for areas of weakness and underperformance as well?
I would expect that the sort of the classic old school large mega cap tech stocks, the Googles, the Facebooks, to continue to do well, in part because of what I just brought up, which is this metaverse concept. And I don't really like the phrase metaverse. I prefer sort of data analysis, manipulation, and usage. This is a data-driven world, and the weird thing about data is, at one level, it's free, and it can be, unlike oil, you can't consume data; you just reuse the same data. But another level, it's incredibly valuable, and the more data you have, the more valuable it gets. And one thing about all of these companies I just mentioned, they're going to own a lot more data in a year's time than they do today.
Yeah, interesting. Look, Pelham, I have to leave it there, but thank you so much indeed for joining us. So look at 2022 from a tech angle. That's Pelham Smithers, founder of the Pelham Smithers Associates. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.